Welcome, Andreas. It's great to have you on the show. So, how are things?
All good. It's been a couple of crazy weeks in global macro here at the beginning of 2023, but I'm decently upbeat despite all of the recession chatter out there. So I'm uh, I'm looking forward to this.
Yeah, perfect. And we'll get into that conversation in a short while. But I think a topic that will become central to this interview, at least, and one that we'll return to, is this idea of Steno Research and your approach. And I'm keen to start with, at least, to narrow, if you can, narrow it down to one thing. What differentiates Steno Research's approach from your peers in this space?
Well, first of all, we intend on saying things exactly as they are. So we don't have any filter. We don't have any politics that we need to consider, which is an advantage in the current market. I have a background within one of the biggest investment banks in Northern Europe, leading the macro team there. And I remember how I needed to navigate a lot of politics on an ongoing basis. And I think it's a huge advantage not to be constrained by political guidelines, not to be constrained by how clients think about the entity that you represent and stuff like that. So we're able to quote unquote tell the truth as we see it, and I think that's one of our key strengths. If we look at our approach to macro investing and macro strategy, what we focus on is liquidity-based models in mostly in US dollars, but also in other currencies. I've spent most of my career trying to navigate so-called structural liquidity, which is usually driven mostly by central banks, but also to a certain extent by treasuries. And I find structural liquidity to be one of the most important measures that you need to stay on top of to asset allocate in a tricky macro environment. So liquidity and truth telling, I would argue those are the two main selling points for Steno Research.
Yeah, fantastic. Well, that's a perfect sort of elevator pitch, and we'll dig into both of those points, I think, when we cover your approach in more detail. But let's circle back and set the interview in context by covering some of your career history to date. Yeah, I'm keen to understand that context because I think it might be important to understand how your earlier career might have informed the way you think about markets. You mentioned you were at Nordea. I think you spent over 10 years there, most recently as chief strategist of global coverage. So what exactly did that role involve?
Well, I had the sort of responsibility to oversee the macro strategy outside of Scandinavia. Nordea is a Scandinavian bank, and obviously, given the Scandinavian heritage, a lot of the research team in Nordea focuses on Scandinavia, but I ran everything outside of Scandinavia for Nordea. So I looked into dollar markets, euro markets, sterling markets, renminbi markets, everything outside of Scandinavia. And I ran the strategy team across asset classes. So basically everything from commodities to fixed income to foreign exchange, but not to any large extent equities, since equities are sort of separate from the research team on other asset classes such as commodities, fixed income, and foreign exchange. And the process is fairly formal, I'd say, in a bank like Nordea. We released the bank's official view on fixed income and foreign exchange on a regular basis. You have to be very precise in forecasting. Also when it comes to the sort of the timings of updates and stuff like that. So it is a very formalized process when you run a research team and an investment bank. And the reason is that you have a client base expecting you to be formalized in your research process, so that they know when to expect updates. Typically, they want updates with forecasts on foreign exchange and fixed income ahead of, for example, committee meetings in pension funds and committee meetings in big corporates, blue chips. So we basically tried to sort of cater the research process to the needs of such clients. So that was about it. We covered right about everything across the globe with a decently sized team. And I think in contrast to many other investment banks, we did a good job at actually advertising for this on social media. Nordea, at least, was one of the biggest banks on social media when I was there. I don't know whether they continue to pursue that strategy now that I'm not part of the business anymore.
Yeah, got it. And we've kind of almost gone into the content side. You talk about social media there. You're producing a lot of content yourself now, not least being a senior editor at Real Vision, but you're a host of Blockworks, The Trading Floor, partnering with Opto Sessions alumnus, Alf Pacatiello, of course. But with so much sort of macroeconomic content in general available to retail investors out there at the moment, what do you think differentiates the way that you approach markets from a content perspective?
Well, first of all, if you look at the product that I produce in conjunction with Alf Picciello on Blockworks, the Macro Trading Floor podcast, we try to have a bit of fun. And one thing I've noticed over the course of the past 10 years in banking and in finance is that a lot of research strategists, they struggle big time when it comes to making content on macroeconomics economics palatable for the broader audience. And I think that's one of my key strengths, that I try to have a bit of fun while doing it. I also try to come up with easily palatable rules on how to understand the world of macro. One example that I can give you is that I've as far as I know, invented the so-called monkey JPEG rule when it comes to Federal Reserve policy. So I've constantly tweeted a meme with Jay Powell, the chairman of Federal Reserve, saying we will continue to hike interest rates unless you morons stop trading monkey JPEGs. And I think that's a very visual way of showing how the Federal Reserve works right now. And I guess you don't see that kind of content from a lot of other content creators within the finance business as well. So I guess that's the best example I can give you. I try to be a bit more jovial relative to the crowd, and I try to have a bit of fun while doing it.
Yeah, absolutely. And having watched a lot of your videos, that comes across straight away. I guess the third sort of element of your career, when I was going through your LinkedIn profile and various other things before the call, was this funding of pretty successful projects within the sort of kind of fintech space, I guess more broadly. You have Scale Up Finance, but then Market Reader as well. And just last week, I spoke to the co-founder and CEO of Market Reader, Jens Nordvig. So I'm just particularly interested more from a kind of personal perspective and just out of curiosity, what excites you most about that project?
Well, first of all, Jens Nordvig is a Dane, so I'm Danish as well. That was one of the reasons why we started talking. But joking aside, and on a more serious note, I think the interesting thing about Market Reader is that it provides you with real-time data on what drives moves across asset classes in a really decentralized world of finance. I guess 10, 15 years back, it wasn't super interesting to look at what happened across various social media channels from the finance perspective. But given the amount of influences out there, it is now of great value to be able to track potential drivers of everything from crypto assets to equity assets to fixed income assets based on real-time indicators such as tweets, such as updates on TikTok, whatever, right? The world of finance is decentralized to an extent that we never thought possible. And therefore, it's much more tricky to figure out what actually drives the price in real time. And even the good old Bloomberg terminal is not super good at it, which is why I think there is a niche for this Market Reader product. So essentially, let's take the example. You could face the situation where a crypto asset just suddenly moves 25%. And it could be linked to something tweeted by Elon Musk, right? The Market Reader software will be able to pinpoint that in a matter of seconds, while it would probably take a while longer before like classic media channels would pick that up. And I think that's of great value to both traders, but also family offices, other big institutions involved in relatively short-term trading. So that's what I like the most. The second thing is that it provides you with a very neat dashboard setup to be able to track what moves and what doesn't. And it's all measured relative to the typical volatility in each asset, meaning that a say 5% move in Bitcoin is not something that will be flagged because it's sort of within the typical range of what you should expect from Bitcoin. But if you get a say 3 standard deviation move, you'll see that immediately on the market reader dashboard. So you'll be able to pinpoint the big movers, and you'll be able to pinpoint why you see the moves in real time.
Yeah,
That's
very
interesting.
interesting. Yeah, we said to Jens that we'd ideally have him back on now. The product's live. I think it's going live this month at least. So we'll get him back on. We can talk about how initial users are interacting with it and give more of a detailed overview of the product. So we'll get into that. Hopefully, one to look out for our listeners. But for this interview, let's move on to your macro outlook. We're speaking as the IMF reported its economic outlook earlier this week, and I was reading your Twitter feed before the call. They've predicted a 6.6% inflation this year and 4.2%, I think, for next year. And on your Twitter feed, you disagree, I think, on both counts. So firstly, then for 2023, why is that way too high, and what's a more likely number, do you think?
Well, first of all, I think it's typically a good idea to bet against the IMF, and one of the reasons why I have that view is that it's probably the most political organization that I could think of within the field of macroeconomics. It takes a long while to turn around such a super tanker, and they've been banging the drum on inflation way too late. They did not foresee the inflation wave coming ahead of it by any means, and I don't think that it will be ahead of the disinflationary wave that we are now amidst. The reason why I'm getting increasingly confident in the so-called disinflation wave that I see for this year is that we get, I'd say, convincing evidence now that wage growth has peaked. And that is of great relevance to the more sticky component to the consumer basket that relates to services. Everything in the service sector is very wage dependent. And as soon as we get the first signs of abating wage growth, it should spill over to service inflation more or less immediately. And therefore, given the amount of focus that we have on service inflation right now, I'd say that this is the next surprise for most market participants, that the service inflation is now actually waning. Everybody agrees that inflation in commodities is waning. It's basically simple math by now, given that we measure inflation in commodities relative to a year ago, where we had that massive spike into the spring due to the invasion of Ukraine. It will be impossible to beat that on a year-over-year basis for inflation. And therefore, we also have disinflation in the price of goods across the board, across the globe. But the price of services is now also declining, I'd say, on a monthly basis, more or less, which is the game changer for the inflation outlook this year. What I feel the most, and why I also disagree with the big drop in the inflation outlook from the IMF in 2024, is that we now celebrate too early when it comes to this inflation battle. I've been saying this since late last summer, that as soon as we get a chance to celebrate declining inflation, we will take that chance and we will repeat the mistakes of the past. I think the incentive structure of a central bank is fairly straightforward. As soon as the public pressure is big enough, they will cave in to the demands of the public. We saw that last year after a few attempts to deem the inflation transitory. They turned around and started hiking interest rates to an extent that we haven't seen in decades, because it was suddenly what was asked by politicians. And now the tide is turning. You see a couple of very relevant US politicians asking the Fed to pause, as we now see layoffs across some of the most important sectors in the US, as we see signs of slowing demand, slowing growth. And as soon as that slowing demand becomes a little bit more broad-based across the US economy, I guess the whole Congress will ask the US Federal Reserve to pause, not least since we have a presidential election coming up in about 20 months' time or thereabout. And that is one of the things that we know, that the Federal Reserve is usually very reluctant to move in strongly in either direction ahead of a presidential election. So I think that is of relevance also when we discuss this inflation outlook. So if they decide to stop hiking as a consequence of politics meddling with their reaction function, I think it's something to worry about for the inflation outlook, say 12, 18 months down the road.
Yeah, great. And you've neatly outlined kind of your methodology and how you're thinking about inflation in general this year and next. But I spoke to Jens about this as well. With so much data out there, it's now, I think, critical more than ever to identify, good data points and bad data points, the ones that actually can be categorized as proper leading indicators and ones that is essentially just noise. Which leading indicators do you use to predict inflation or the trend of inflation?
So it depends a bit on the time horizon. For the relatively short-term outlook for inflation, I tend to like surveys asking companies for their price plans the most. The best survey out there is the so-called NFIB survey. It is a survey conducted among SMEs in the US, and you simply ask the SMEs whether they intend on hiking prices relative to the current price plans. And when you get a very uniform response from the SMEs, then it's typically a signal that you should expect inflation to accelerate. And right now, we have about net 20% of the SMEs saying that they will hike prices relative to current price plans. And that is not particularly high from a historical context. When you get net 50 or 60% saying that they will hike prices relative to their current price plans, it is something to worry about. But 20% net in that survey is roughly equal to 2-3% inflation, something thereabout. So typical inflation levels, right? That's essentially the signal we get from that survey right now. We just before we started recording here, we had the prices paid survey from the ISM Institute out as well. That is another relevant price gauge, at least for the manufacturing sector. It gives you a decent prediction of goods inflation 3-6 months down the road. But if we look for long-term inflation indicators, or rather medium-term inflation indicators with a lead of 9 to 12 months, then I essentially lean on liquidity-based indicators. So if we see a strong increase in the monetary base, if we see a strong increase in bank lending, I would consider those firm hints that inflation will increase with the time lag of 3 to 4 quarters. Right now, we see the opposite. So very weak developments in broad money measures such as M2, relatively weak developments in bank lending relative to a couple of months ago, still decent in a historical context, but slowing momentum in some of these broader money measures. And I think that it is of relevance for the medium-term outlook for inflation. If I look a bit further ahead, and I guess some people will accuse me of correlation sugarcoating, if that's a word. I tend to look at the Chinese credit cycle as the best leading indicator for inflation in the West, with, say, 1 to 2 years of lead. And I think the reason is that Chinese credit is the first sign of changing momentum in the commodity space. So when the Chinese credit cycle starts accelerating, you should expect the commodity cycle to accelerate after a while. And that will slowly but surely spill over to a lot of prices in the West. But it takes a while. And I mean, over the course of Q4 and into the early parts of 23, we've actually seen a decent pickup in lending in China, alongside the reopening of the entire economy. And that could be one reason, as well as the political backdrop I mentioned, to worry about inflation into 24. But it takes a while from the first signs of credit creation in China until we actually see it here.
Yeah, got it. I mean, that's fascinating. I've asked that question a couple of times. I'm not sure we've ever got as full an answer as that. So thank you very much for that. Okay, well, let's move on to another topic that's central, I think, to establishing the macro outlook, and that's the question of recession. The BLS recently released the Business Employment Dynamics Summary, which hinted at net job losses in Q2 last year, while the NFP at the same time hinted at circa 1 million jobs added. So firstly, which labour market statistics should we trust?
It's a tricky question. And I've spent most of the past week discussing this exact topic with hedge funds, with people I know with a background within the BLS. And I still don't really take any comfort in any of the explanations that I've received. It's the biggest gap that we've ever seen between the non-farm payrolls and this labor dynamics survey from the same institute, ultimately, the Bureau of Labor Statistics, right? So we've never seen such a big gap. And I don't really find anyone convincingly able to tell me the true difference between the two. They typically correlate very well over time. So I guess either of the two surveys will have to give in at some point when they're revised once again. The labor dynamics survey basically looks recessionary for Q2 last year. Reason being that it actually shows a net job loss in the US economy in the second quarter last year. And it is a gauge designed to try and measure the net job creation from the net birth minus the net death of establishments. And it is in sharp contrast to what we see in the non-farm payrolls report month in and month out, where we see a lot of jobs added due to a very high ratio between new companies entering the survey relative to the amount of companies defaulting during the same period. And as far as I can see from the BLS, we don't have exact numbers for business death rates outside of, I think, Q4 21 still. So the data lags extremely by an extreme time frame, while we have confirmed data up until Q2 last year on establishments being born during 22. So we are still kind of guessing when it comes to this birth rate of establishments relative to death rates of establishments. And I think the reason is that all of the aid packages created during the pandemic has wreaked havoc with methodologies from the Bureau of Labor Statistics. And right now, I guess we sort of artificially find death rates of establishments at extremely low levels because of aid packages allowing them to stay alive for longer. But it doesn't necessarily mean that they hire or that they run sound business models. It's actually the same if you look across the West. We have death rates of establishments at extremely low levels post the pandemic, and I'm not entirely sure that I buy it. I think it's related to the aid packages of the pandemic.
Okay, so if I guess the answer to that question is unclear, at least looking at those two sets of data anyway, and the divergence between them, why is that question, the answer to that question, of major relevance to asset class performance this year, do you think?
Imagine if the recession is already behind us. It would be super weird but I wouldn't completely rule it out. Um, and the only reason why we are stuck in this discussion without being able to provide the true answer is that most key figures have struggled to clearly assess the economic momentum since the pandemic. You can see it across purchasing manager indices, labor market reports, and so on and so forth. They've struggled due to the volatility of the pandemic, and they are not as precise as they were in 2019. And it would be the first time in history, as far as I'm concerned, that we would discuss a recession in hindsight. And if you look at the asset allocation right now, it is right about every asset manager out there is expecting a recession within a time frame of say 6 to 12 months from here, and therefore I would suppose that it would wrongfoot many if the recession is already behind us. I'm not saying that it's my base case that we end up concluding that, but it would be an extremely weird scenario relative to what we've penciled in as the base case for most asset allocation models for this year. Frankly speaking, the discussion we've had so far this year is whether the recession will commence during the first half of the year or the second half of the year, right? And I think most asset managers entered the year with a base case of a recession commencing in the first half of the year. And that consensus is slowly but surely moving to the second half of the year. So everyone and their mother is stuck in a discussion on whether to asset allocate with the expectation of a recession in the near-term horizon. And if the recession was already last year, then I guess everyone would be wrong-footed in their positioning.
Yeah. Okay. Got it. Well, let's return, I think, to the central topic of today's interview, and that is the research or the research approach you employ at Steno Research. And having explained, I think, the macro environment and set the context for the interview, I'd like to use your macro asset allocation framework to help apply this information in an investment context. So, firstly, perhaps you can briefly tell us how the Steno Signals macro regime indicator works.
Well, it's a fairly simple framework, and yet extremely tricky. So we look at three basic parameters. First of all, structural liquidity. I mentioned that as a niche of our little macro research shop. So what we measure is the structural liquidity in each and every currency across the major geographies worldwide. And when I talk about structural liquidity, I basically talk about the bank reserves. So the currency created by the central bank and the currency held by commercial banks at deposits at the central bank. I think this is a relevant asset allocation variable. And if you look over the course of the past 18 to 24 months, it's been the driver of global asset allocation. So that's parameter number one. The second parameter is inflation. Given that we have inflation back in the limelight with the huge spike we saw in prices during last year, I think it's relevant for your asset allocation whether inflation is accelerating or decelerating. So we look at inflation on a month-over-month basis in this framework. And then we look at growth, so basically PMIs on a monthly basis as well in this framework. The reason why I called it a pretty simple framework is that structural liquidity is just a time series. You can find it in the St. Louis Fed database, the FRED database. It's just called Depository Reserves from Commercial Banks. So you can look that time series up. It's not tricky to find it. You can look the CPI index up. It's not tricky to find it. And you can look up the Purchasing Manager Index of the US, just to give you an example of the three parameters going into our US model. The tricky thing is to forecast these three parameters ahead of time, right? Ahead of the curve. And I think that is where we spent the most time in our little research shop. We try to be accurate in our forecasting on PMIs, on the CPI, and on structural liquidity. And I actually think it's at least decently manageable to forecast the trends in each of the three components. And when we get a firm signal of liquidity rising, inflation rising, and growth rising at the same time, then we have a specific signal creating an asset allocation on the back of it. And the same goes for the exact opposite signal, the down, down, down signal, the liquidity down, inflation down, and growth down. That's sort of the extreme opposite of the up, up, up view. But I would actually argue that the best possible combination of these three would be structural liquidity going up, inflation going down, and growth going up at the same time. I've called that the gung-ho macro regime. And I actually think that January has been a great example of the gung-ho macro regime. Liquidity has gone up due to a couple of technical reasons in the US. Inflation has waned throughout the month. I think that's safe to say with the amount of indicators out now. And growth rebounded slightly in January due to the positive impulse from the reopening of China. So, I mean, it's been kind of a surprise to many how strongly January has performed in equity space. But we actually entered the year long on a net basis in equity space as one of the very few research shops. And I think it's because we track these elements on a timely manner.
Yeah, interesting. Well, you mentioned a few of them there, but I think there's 8 regimes in total.
Yeah.
Just interested to understand, I suppose, what went into producing a kind of suitable, reliable regime taxonomy, and kind of whether it can be exhaustive in its coverage of potential economic outcomes and environments.
Well, I think it's impossible to create an exhaustive list of macro regimes. You could argue to add other variables. For example, you could argue to add a geopolitical variable.
Yeah.
One of, and I perfectly admit to this, this exact framework told you to do everything that you shouldn't do right after Putin invaded Ukraine.
Right.
That's just to take one example, right?
Yeah.
So you could basically be chasing money in front of a steamroller if you're geopolitically wrong-footed with this framework. So that's just one example of this framework not being exhaustive. But I like to forecast variables that I find possible forecasting, if you know what I mean.
Yeah.
And leave forecasting of other variables outside of this framework, and then obviously try and look into risk scenarios around the framework after the framework provides a model-based asset allocation. These three parameters will oftentimes provide you with a decent signal for your macro allocation, unless you're wrong-footed by things outside of this framework, such as geopolitics.
Yeah. Okay, got it. You're forecasting the forecastable essentially, rather than trying
Yes.
to predict what Putin's going to do. That makes a lot of sense. So over what time frame is the framework most useful, or is that specific to how an investor's time horizon is set up? Like, yeah, is there anything? Is it statistically more accurate over a certain time frame? Is perhaps a better question.
It's actually fairly short term,
Okay.
which is interesting. So I'd say that the time frame of this framework is below 3 months.
Right.
And the reason why I aim to optimize returns with such a short time horizon is that my typical client would be a macro hedge fund or a very active high net worth individual. And this is an attempt to time very short-term macro trends. This framework could tell you to expect inflation to drop over the next couple of months, and then lead the asset allocation in that direction, even though it is a very feasible scenario that inflation will print at higher levels than the past decade, right? So this is a momentum-based setup where you look at liquidity, inflation, and growth relative to the month prior, and try to forecast the next month via forward-leading indicators. And therefore, it is by nature a relatively short-term setup. I guess you could develop a setup with less predictability, but also decent hit ratios with longer time frames. If you look at these three parameters with other input variables, as I told you when we discussed how to forecast inflation, this framework will rely a lot on price surveys from companies because I want to pinpoint short-term trends. If I wanted to allocate with a longer time horizon, I would probably look into more monetary-based variables on the inflation component, just to give you an example of the difference
Mm.
between time frames.
Yeah. Okay. Got it. Well, we've kind of already touched on it, but if we are to use this regime indicator to allocate or make allocation decisions, we've mentioned what regime we were in January. What regime does it predict, or does it say we're in now, or February into March?
Well, I've labeled the regime QE,
Hmm.
which may be kind of misleading right now,
Okay.
since the liquidity addition that we should expect in February and March is not driven by QE, but rather by debt ceiling technicalities. Um, when we look at structural liquidity in the US, and it's, by the way, the same across other geographies, we need to take into account how the treasury in each and every country operates when it comes to issuance and cash holdings. And right now, the US Treasury is simply forced from this date and until the end of April, roughly, to bring down the holdings of cash at the Federal Reserve, as they are not allowed to hold a lot of idle cash when the debt ceiling is in force in the US. So they are not allowed to incentivize politicians to drag out negotiations around a new level of the debt ceiling, which means that they will have to bring this cash buffer that they have at the Federal Reserve down. And commercial banks, ultimately you and I, if you know what I mean, will be on the receiving end of this liquidity from the US Treasury. So structural liquidity can either be held at a treasury account or at an account at a private bank. So when the treasury draws down on their account, private banks will receive it. And that's essentially what's going to happen in February and March. And then our forward-looking indicators for growth for February and March look pretty gloomy. So orders to inventories for the ISM, for example, the PMI in the US, just after the release, just before we recorded, predicts a headline number for the PMI below 45 in 2 months from now, so clearly lower than today's number. Our inflation indicators point to a landslide in headline inflation in the next couple of months, based on a clear indication from price plans. So growth down, inflation down, liquidity up. Is a weird cocktail, but it's not necessarily super bad for equities. I would expect equities to fare decently well with that cocktail for the time being.
Great. Okay. Yeah. Cool. I was going to ask about equities. Well, we're speaking on the 1st of February, and I think the tool launches actually this month for premium clients of Steno Research. So, where can listeners check it out?
Well, you can find me on Twitter at the handle at Andreas Steno. Otherwise, you can go to stenoresearch.com. I'm happy to provide you with a very short term trial if you want to check out the tools, etc. And other than that, I host regular podcasts with Blogworks called the Macro Trading Floor. I also host regular video interviews with some of the best investors worldwide on Real Vision. So I urge you to go check those out as well. And I should be all over the place on social media, at least relative to a lot of peers. So if you Google my name, you'll be able to find some content at least.
Yeah, fantastic. We'll include links to both the content and Steno Research's website in the episode description, so people can see those directly. But before you go, I wanted to pick your brains on another of your tools, which was your BetaTrackers.
Yeah.
And I think, again, reading an article on your blog, you highlighted that important tool. So as far as I can tell, for each of the important asset allocation variables, you'll update these trackers, which are designed to
Mm.
hint at how to allocate within each asset class.
Yeah.
So perhaps to make this a little less abstract, can you talk us through an example?
Yeah. So let's take the example of inflation again. What we update on a regular basis in our toolbox is the so-called beta in each and every equity index, equity subsector across various geographies to, for example, the US CPI. And in our macro regime framework, we have the US CPI as one of the main asset allocation tools. So what we can do based on historical correlations is that we can judge whether a drop in the US inflation is positive or negative for an equity index or an equity subsector. If we take the example of US inflation relative to US equities, the short story is that a drop in inflation is typically decently positive for the equity market overall, since it allows for a less hawkish central bank policy. I think that's the straight way to conclude why and lower inflation print is positive for equity markets. It's not necessarily always the case, but it works that way on historical correlations. What I find extra interesting is to look at equity sectors relative to inflation. So which sectors like inflation and which sectors dislike inflation. And what I mean with a beta is the percentage change you should expect in an equity or an equity subsector if the inflation index moves by 1 percentage point. So if inflation moves from 5 to 4%, how much should you expect the tech sector to move as a consequence of that? And when inflation drops, the tech sector is actually one of the few sectors with a very, very positive beta to such a move, meaning that when inflation drops from 5 to 4%, you should expect, say, a 2.7% move in tech sector equities. So that is what we measure in these beta dashboards. They constantly update based on a rolling correlation study between equities and, for example, inflation. And we run these beta dashboards across all the major asset allocation variables in the macro regime indicator, but we also run them based on some of the more ad hoc discretionary themes relevant to macro allocation. One could be currently the Chinese reopening, right? After China openly communicated that they reopened the economy, we added dashboards on the Chinese PMI relative to equities across the globe to figure out which sectors to buy, which countries to buy. And it actually worked out pretty well for us through January. It told you to buy countries with a clear link to industrial metals. So Chile, Mexico, Brazil, and to be less upbeat on countries with no link to China and with a slightly more energy intensive business setup in general. And therefore, countries like Germany, Chile, Mexico, and Brazil have performed, while a country like India has been one of the relative losers of this reopening of China, and the dashboard basically predicted that.
Yeah, got it. And I'm not sure to what extent the tools were produced or designed with this in mind, but it struck me that you could potentially use the regime indicator and the beta trackers in tandem as part of a top-down investment strategy. You know, you have the asset allocation determined by the macro regime indicator, and then beta trackers to inform sector allocation if you're an equity investor, perhaps. Should it work that way? Was that in mind?
Yeah, I think that's a very good way of explaining it. And we run these beta trackers across equities, across foreign exchange, across fixed income and commodities, etc. So you can basically use it as soon as you have the macro regime in place where you sort of place your bets across assets, then you can move one layer lower and allocate based on the beta trackers within each asset class.
Yeah, got it. And a final question just to round off this beta tracker conversation then is, over what time horizon, I asked you this about the previous tool, but over what time horizon should this data be considered, or is it most valuable or useful?
Again, my best take is that this is a short-term tool, since it's designed to optimize short-term returns. So I wouldn't count on correlations to optimize your very long-term portfolio allocation, since correlations are notoriously volatile. Just ask most pension funds, for example, the Danish public pension fund, about whether it's a good idea to place all your bets on so-called risk parity strategies. They are basically designed to be long-term correlation steady strategies, right? Last year correlations were upside down, and our beta trackers would have captured that with a very short time lag, since they update correlations on a running basis, designed to earn a return on a short-term basis. So they will not stick to an old correlation regime. They will update to a new correlation regime with a much swifter, within a much swifter time frame than sort of long-term correlation-based models such as risk parity strategies.
Yeah, fantastic. Well, I think that's a fascinating insight to end on. And with that, just leaves me to say thank you very much for joining us on the podcast, Andreas. It's been a real pleasure.
Thank you so much for hosting me, Hayden.